Hello and welcome to this week's edition of Retire Well, the show designed to help you build a better life. I'm your host, Kristen Oakley, and joining me in the studio today are two members from Citizen Advisory Group. We have the co-founder and financial advisor, Kevin Bucher, and financial advisor, Pete Samenuk. We're so glad you're joining us today. The title of this episode is The Tax Time Bomb: What Retirees Must Know Before It's Too Late. And you're definitely going to want to stay with us because this is one of those instances where what you don't know can absolutely hurt you, and we don't want that to happen to you and your hard-earned money. So Kevin, Pete, excited to be here with both of you. How are you this week?
Good.
Yes.
I always love talking about taxes, right? Never gets old, does it?
Yes.
There's a lot to talk about when it comes to taxes.
It is, for sure. So we have a jam-packed episode, and again, we're calling this the tax time bomb. And I think a lot of folks, and I think you would agree with this, really focus on the question of, have I saved enough, right? That's where the stress is. Have I done enough? Have I saved enough for my retirement? But the question that often gets overlooked is, how much of what you have saved are you actually going to be able to keep? Because what a lot of folks don't realize is they've worked so hard, they've saved this amount. It's not all your money. If it's in a tax-deferred account, guess what? The IRS is your partner in that account. So we have to address this because taxes can become one of the biggest threats and unexpected detriments to your success in retirement. So here's the good news. It's a problem. It's a problem for most folks probably who are watching, but there's solutions, and we're going to get to that today as well. So I'm curious, as we kick off today's show, define what you are referring to when you use the phrase tax time bomb.
Well, my mind immediately goes to a Mission Impossible movie,
Nice.
and there's all these different bombs. No, so it's a tax time bomb because in most situations, people are taking advantage of saving for retirement inside of their employer-sponsored 401k plan, 403b, 457, and they're doing that on a tax-deferred basis, or they're using a traditional IRA to take advantage of getting a tax deduction. But in reality, you're creating a tax bomb for yourself in the future. You just haven't lit the wick yet. And I don't know, that's probably not how you do bombs anymore. I don't think you actually, it's all computerized. So I might have dated myself a little bit.
I'm going back to a Looney Tunes,
Yeah,
Roadrunner cartoon or something.
That
but
is
yes.
my experience with
Yes.
bombs. So
Fireworks still work that way. I can confirm.
okay.
There you go.
Yes. So, but you haven't lit the fuse. And I think one of the things we want to try to highlight today is it's not about just that tax bomb of the IRA account or the 401k. There's all these other little bombs that are set up out there that when that one fuse is lit, it might be lighting the fuse for other bombs associated with other things that would be unrelated to income and taxes, like health insurance, for example.
Yep. So most folks have this, and the reality is that those taxes haven't gone away. They've just been delayed, right? They've kicked the can down the road, and that's true because the majority of Americans have the bulk of their wealth saved up in tax-deferred accounts. So, from your experience, Pete, what do people need to understand about this whole concept of, okay, not all that money is yours?
Yeah, I mean, Kevin talked about the concern for people. The big concern is, do I have enough? Have I done enough? Have I saved enough? And you have to keep in mind is, it's nice to have more. You're saving more. You're growing your accounts more. Stock markets have been tremendous lately. So, lately I could say that over the last 15 years. So you're growing more, but not all of that money. You have a partner in that savings plan, and that's Uncle Sam, the IRS. So not all of that money belongs to you. So you do have to think about the difference between what you're actually taking out of an account and what's actually spendable income. So if you have, we'll just use somewhat simple math. If you take $1 out of an account, how much of that do you get to keep? Do you actually get $1 to spend? No, because there's somebody that gets paid first, and that's your taxes. So that's the federal government, that's your state government, that could be local government, depending on the county and the state and the situation. I do have people that run into that problem. So before you even get to keep any of that dollar, they might shave 30 cents right off the top, and then you have 70 cents left. So I always like to make that comparison, is that what you're taking out is not actually what you get to keep. And that's the big problem people kind of forget about.
Well, and this is why we like to bring awareness to this, and we have a very special resource that I know whenever we talk about this on the show, you get an influx of folks who are then calling you guys saying, hey, help me fix this problem. Help me diffuse this tax time bomb, if you will. So we want to offer this resource for you. It's what we call internally as our tax bill calculator. It's a free online tool that you can use, so we invite you to visit it by going to mytaxbilltest.com. You can also get there by scanning that QR code, if I can get that out right. But in a matter of minutes, just by entering some basic information, this software will actually show you the difference between the government's tax plan for you if you do nothing versus how much less you could pay in tax if you engage in some strategic tax planning. And this is very valuable for folks to be able to see those numbers, because we always say once you see it, you can't unsee it. And part of this has to do with required minimum distributions that come into play. So explain, because I know what this tax bill calculator will do in the complimentary report that will be emailed to folks, is even give them a schedule and show them their RMD breakdown.
Yeah, and it's a little general when it comes to that, but it is at least showing you, like you said, visually, how you can start to plan for your required minimum distributions. That's when on your pre-tax accounts, they do start to force you at a certain age. That's anywhere, most people moving forward will be 75 and above, or starting at 73, but they are going to force you to start taking money out of those pre-tax accounts. And the big problem there, one of the big problems when Kevin talked about there's little tax bombs all over our plans, is that those are forced. And so that might be forced in a time that might not be very beneficial to take it, right? What if we're in the middle of a 30% stock market dip? Or we have a lot of volatility going in the market right now, and it's like, it's just not a good time to take money in a lump sum out of that account. They're gonna force you to do it. So that's a big thing to remember, is that when it's forced, it might be forced at a very inopportune time in your individual plan.
So you mentioned multiple tax bombs that could potentially go off, right? Explain what you mean by that.
Well, so I think we've already kind of hit the point, right? When I take a withdrawal from an IRA or a 401k, that is going to be taxable income to me, and I got to pay the tax on that. It could potentially be putting me up into a higher tax bracket, so I would call that the first bomb, that, okay, I was in the 12%, but I took this additional withdrawal, so now I'm paying taxes at 22%. So I would call that a bomb. That's a pretty big jump. It also could increase the taxable portion of your Social Security benefit. So some of your Social Security comes out tax-free, some of it you pay tax on, but when I take extra income, not only do I pay tax on that income, I pay tax on more of my Social Security, so it's like a double tax, seems fair. And then the third thing is, as your income goes up, it may increase what your health insurance premiums are, both through the Affordable Care Act or even when you're on Medicare, to where when I hit certain income levels, I might have to pay additional Medicare premiums. So I would call that those additional bombs that are setting out there, that we took this IRA withdrawal, we pay the tax on it, but it triggers tax on my Social Security, it triggers higher Medicare premiums. Those are all the other bombs that are setting out there in the whole Mission Impossible.
And you know what another area is, as you're saying that, it makes me think of, we've run into this a lot. It can also cause some of your other investments that weren't taxable before to actually be taxed at an additional 15%. And some of your dividends.
Yeah, explain how that happens.
We might have a portion in the show later on this, I'm not sure, but when Kevin's talking about all the tax bombs and the ripple effect, is that if you have more taxable income from things like IRAs, pensions, 401ks, it's actually causing taxes on some of your other outside investments that you don't realize. Dividends might now be taxed at 15%. Before they were 0. Capital gains, that's bumping you into a capital gains bracket. So a lot of your income that you got from selling stocks and things in non-qualified accounts might have been 0. That's now causing 15%. So that 15% goes right on top of that 22% that Kevin was saying. And I'm running into a lot of that right now, and it's just making me think of that big ripple effect and that domino.
Yes, so it's not just about the tax rate, it's about this ripple effect. And this is why this tax bomb needs to be talked about and mitigated. So what would you say to someone who's watching? Maybe they've already visited mytaxbilltest.com and their jaw might be on the floor after they have seen the difference between those two plans. How would them being able to come in and meet with you all help them dismantle their own potential tax bomb?
Well, so these bombs can be diffused. I mean, if you've seen the movies, they eventually, there might only be 1 second left on the clock. And that's true with the taxes, where you need to diffuse these bombs as well as you can, but it has to be done strategically. And so that's where We utilize a tax planning software that kind of maps this out for us. It clearly sets where the targets are for how much money we should be dealing with from a tax standpoint year over year. So we have to start systematically diffusing these bombs so that they don't go off. We know that they're going to go off at some point, but we don't know when they're going to go off. And there's some of it that we can control today, some of it we can't control, but we want to get out ahead of it.
Exactly right. So again, if this is something that's resonating with you, or if you're already working with another financial professional and they're not having these kinds of conversations with you, you owe it to yourself to get a second opinion. And the team of Citizen Advisory Group would love to be able to provide that for you in the form of your very own complimentary retirement checkpoint review. To schedule yours, simply call the number that you see there on the bottom of your screen, 866-630-1675. Or if you'd rather connect online, you're welcome to scan that QR code and that will get you connected as well. Stay with us. We're going to continue this important conversation and walk you through some steps and strategies to help you diffuse the tax time bomb in your retirement plan right after this.
So Citizen Advisory Group is a phenomenal place to work for. We work very hard day to day. However, I think what makes us special is the fact that there's a lot of camaraderie between us. All of us are friends. We like hanging out outside of work. We like to ask about each other's families and trips and hobbies and things like that. That just kind of bleeds into our culture. So that's a culture of, respect, friendship, camaraderie. And I think that comes across to clients as well. They see how well we treat each other. They see that bond that we as employees have. And ultimately, we're all serving the same purpose, which is serving our client base and ensuring that they have the financial future and picture that they want.
Did you ever think your own retirement would be shared with our government? It's true. Your 401k, IRA, pension, or similar retirement accounts are in partnership with Uncle Sam. Simply put, they want their tax dollars and you have them. With our latest tax calculator, you can plug in your own numbers while sitting at home to see what your tax liability to Uncle Sam projects to be. Scan the QR code or go to mytaxbilltest.com.
Welcome back to Retire Well. I'm Kristen Oakley here with both Kevin and Pete from Citizen Advisory Group, and we're so glad that you're joining us today. If you're just tuning in, today's conversation is focusing in on the tax time bomb that exists in your retirement accounts. But here's the good news. You can take steps even now to diffuse this ticking tax time bomb. And if you've not yet accessed our tax bill calculator, which will actually show you what your potential tax bill might be in retirement, we encourage you to use this online interactive assessment. It's completely free. You can visit it by going to mytaxbilltest.com or by scanning that QR code, and in a matter of minutes, you're going to receive a complimentary 4-page report emailed to you showing you the breakdown of your numbers. And as we said earlier, once you see the difference between what the government's plan is for you versus how much less you could pay in taxes, folks are really motivated to diffuse this tax bomb, right?
Well, you got to do it before it's too late.
Yes.
Right?
Yep.
And
before the clock runs out, right?
There's more that you can do about it than you think, but you have to take action as soon as possible, because every year you miss is a year you cannot reclaim and take advantage of.
Yeah, for sure. Well, and that feeds really well into the next subject we're going to talk about, why it's so important to get in front of this sooner rather than later. Because we did an entire show previously on what we call the widow's tax trap. And it's what happens when one spouse passes away. So let's start off with what we're talking about here and why this is so important for married couples who are watching to get in front of.
It's an unfortunate reality, and I think Pete and I would both be able to attest to the fact that we've had to deal with it way too often lately, where we've lost some of our dear friends and clients unexpectedly. But let me take a step backwards just for a minute. That a part of the financial planning process needs to be a written retirement income plan. And in that written retirement income plan, we need to model what it looks like when the first spouse passes away. So before we even get into the tax side of it, we need to understand and make sure that when the first spouse passes, that there's still going to be adequate income resources to support that survivor's lifestyle. So that's a really important step to this, that we need to be able to show you what it looks like when the first of you passes, that we can then take that information and start to do some of the tax modeling on.
Mm-hmm. And so there's this shift. What I think is interesting is a lot of folks, I've talked to older married couples who don't realize why this could be so problematic for them. So can you explain, the whole, okay, maybe your income's not going to change as much, but why their tax situation?
Yeah, and Kevin was talking about the software and some of the visual things that we use to model out earlier. And when you can see these things and visualize them, it's a little bit easier than what I'm going to try to describe right now. But 99% of the time, maybe not that high, 95% of the time when a spouse dies, we're losing some income. So we're losing income just from losing one Social Security benefit, or maybe a pension's getting lowered, or maybe you're losing a pension entirely. There's just almost always a natural reduction in income for a surviving spouse. Now, sometimes that might not be a lot. I might have clients lose 10% of their income or 20% of their income for a surviving spouse. But what people don't realize is that a lot of times we have people with less income as a surviving spouse and they're paying more taxes. Okay, so I've had a lot of things we're modeling out. Like Kevin just mentioned, we've dealt with this a lot. And Kevin, weren't we just talking about this at the office last week, 2 weeks ago, that widow's tax trap, because we've been seeing it so much, is it's a trap, isn't it?
Yeah.
It's a trap. I have clients losing 30% of the income and paying 40% more in taxes. Those are not made up numbers. It's the truth. Just because you're going to single taxpayer rates, your standard deductions are being cut, you're not getting the additional deduction. There's just all sorts of things, those little bombs we talked about hiding in there.
And I think that's the main point, is that you might lose some Social Security benefits, you might lose some of the pensions, but what you didn't lose was the bomb. You are inheriting the full bomb, and now you have to deal with that bomb using lower deductions, lower tax rates.
And it's a big problem when it comes to the IRMA. So Kevin talked about paying more for your healthcare premiums as a single person.
Right.
I have people that, I can keep you somewhat below those Medicare tiers and those thresholds for the penalty, quote unquote. But as a single taxpayer, I have widows, you're never avoiding it. Sometimes you're all the way through. You were talking about that client, he lost his wife, and he was already through the third or fourth tier naturally, and you're never going to do anything about it because your pension's coming in, Social Security's coming in, and you're forced to still take those required minimum distributions.
Exactly. I was going to say that those are all the compounding factors that then complicate the situation. And what's awful is this is all happening during a time when somebody's emotionally grieving the loss of their loved one. And this is why we talk about this. I think this is why when folks hear us talk about the widow's tax trap, they're motivated to get in front of it, because when you're grieving, that's not the time on top of everything else you want to have to deal with this nightmare.
Yeah, those have been tough situations. And I don't know, Kevin, if you had anything to say about that, but those have been some tough conversations I've had. And especially if someone passes late in the year and then all of a sudden we're looking at their taxes for next year. And it is a very emotional moment, because they're like, well, this just isn't fair. Why am I paying more taxes right in the middle of all of this happening, and my dollars aren't getting me as far? And sometimes with those widow situations, they can happen early in life. So we have clients that pass away in their 60s and early 70s, and you might be dealing with that widow's tax situation for 25 to 30 more years. It's a long time. It's not just 1 year. It's not just two. It's the rest of your life, really. So.
Yeah.
And if I was just going to add anything to that, it's one of the worst things that can happen to you in your life, right? Losing a spouse.
Yes.
And it's really difficult. You're going through a lot at that time. And so dealing with things like income and taxes and insurance, I mean, that is not the frame of mind that you are likely in. And it just highlights the importance of doing financial planning and being prepared for these things, because then it's just a matter of implementing what has already been discussed and laid out. And the sooner you can start to address these things, the more efficiently you can do it.
Yes.
Like I said, we've just seen it too much lately. We don't get to control that part, unfortunately, of how much time we have here. But at a time of life when you are going through one of the worst things that can happen to you, you should not have to be dealing with excess taxes, changes to your insurance costs. So we've got to get out ahead of that, and the time to do that is now.
And we do plan for it, right? We do plan for that, and pretty much every single plan that we have, we plan for the untimely death of a spouse. Has to happen.
It has to happen for sure. And I think that's the beauty of doing this retirement checkpoint review, is that the team of Citizen Advisory Group can come alongside you, show you where these potential bombs might exist, and then help you take steps even now before that day comes to diffuse them. So we encourage you to reach out. We know that a lot of this might be new to you. The good news is it's not new to Kevin and Pete and the team. You don't have to go it alone, and they are here to help and serve you. But you do need to reach out. So we encourage you to do so by calling 866-630-1675. Or again, if you'd rather connect online, simply scan that QR code and that will get you connected as well. Stay with us. We'll be back with more right after this.
There's no shortage of opinions about annuities. Some people love them, others hate them. But here's what matters. The right annuity in the right situation can solve very specific retirement challenges. Whether it's guaranteed income, market protection, or legacy planning, different annuities are built to serve different purposes. The problem is too many people own annuities that no longer match their goals, or worse, never did. Some have high fees, others come with outdated features, and too often, people buy them without understanding what they're getting. If you've been holding on to an annuity for years, or if you're not sure exactly what you have or how it works, now is the time to take a second look. Our complimentary annuity review can help you understand what you own, what it's doing for you, and whether something better is available in today's market. Refinance your annuity today and make sure it's working for you, not against you.
Welcome back to Retire Well, where today we've been discussing the tax time bomb that is sitting in your retirement accounts. And really, what we are talking about is how you can turn a potential problem into a proactive strategy. And that's what we want to focus the rest of today's conversation on. What are some of the strategies that you can employ to start diffusing that tax bomb? And if you've not yet visited our tax bill calculator, what are you waiting for? We know your smartphone is sitting right there. We encourage you to go to this online interactive assessment. It is going to be so beneficial for you to see your numbers, and you can access it by going to mytaxbilltest.com or by scanning that QR code. And really what the software does is it maps out for people what their potential tax bill might be over the rest of their lives, but then also shows them, okay, but this is how much less you could pay in tax if you engage in some of these strategies that we're going to talk about now. So what do these strategies entail? What does that look like?
Yeah, and it's going to be hard for us to really lay it out and give all of the secret sauce today, because there's still things that we're learning. But you're looking at what can we proactively do the rest of this year in 2026, the next year, 5 years, the next 30 years of our lives, and really laying out what potential taxes are going to look like over that time. Do we need to start doing some Roth conversion strategies? Do we need to start accelerating where we're taking payments from? This has a lot to do with distribution planning and where we're actually getting our money. And I have all the time, I have people that their tendency, if they have a large purchase or just something unexpected, and someone might need $30,000, $35,000 for a car or a roof or something like that, and their tendency is to take it from, their money that's already been taxed. Maybe they're after tax, but there's a lot of opportunity if we're staying within certain tax brackets that we should be attacking that pre-tax money first. So a lot of it's just around, preparing and knowing where we're taking our distributions from, things along those lines.
And it's not a one-time thing. This is an ongoing, proactive, coordinated, well-timed strategy that then you employ for the folks that you're working with. I think that's important to understand. It's not a set it and forget it thing.
Yeah, it's annual work. Number one, people's situation changes, the tax laws change. We just had a huge legislation passed last year with the one big beautiful bill. So we have to be able to be reactive to that, but we have to have a long-term strategy as well.
Yes.
So I look at, one of the strategies is to do Roth conversions potentially. So a Roth conversion is the process of taking money from an IRA or a 401k account and that hasn't been taxed yet, and then converting that to a Roth account where once you've paid the tax to get it in there is now a tax-free account. So think about how significant that is over the past couple years with the strong market performance that we've seen. So it feels really good to get good returns. But the reality is, if those returns are happening inside of the traditional 401k and IRA accounts, every dollar that you're earning is also a dollar you're earning for Uncle Sam. Whereas if I could get that money repositioned into the Roth account, every dollar that I'm earning is now a dollar for me and my family because I've already paid Uncle Sam off of the deal. So we have to look at strategies for Roth converting. We have to look at strategies on how to deal with our capital gains that we might have in our non-retirement accounts. So we're doing gain and loss harvesting. And to your point, it is, I think it's been ingrained in all of us to avoid tax. So every year we're looking at tax avoidance techniques.
Like, how do we save just for this current year that we're in? Right.
Yeah.
And sometimes that is very detrimental to your long-term tax plan. So we really have to have a long-term focus to this that really extends not just within my lifetime. We have to look at our whole family dynamic sometimes to figure out strategies to reduce how much of our nest egg is going to be paid in taxes.
Well, because another one of the biggest, we didn't talk about this, we talked about all these little tax bombs that are all over the place, but what's really, Kevin, something we didn't mention, what's one of the biggest tax bombs out there right now? It's the change in legislation to how inherited 401k and IRAs are handled.
The stretch IRA provision
The stretch
is
IRA
gone.
provisions are completely changed and overhauled. So I have people, and this is important for younger folks that are starting to maybe inherit assets from their parents, my baby boomers that are starting to inherit assets from their elderly parents, is that the inherited IRA rules have completely changed, and people are going to get killed in taxes on that without proactive planning. I'm talking about, instead of giving away 40% of the account by doing nothing, you really should only be giving away 15 to 20% of those total assets. So major tax bomb, it's completely changed our perspective on distribution planning and all of that.
Well, I think the big takeaway is this is something you don't want to try at home on your own, right? This takes expertise and a detailed level of planning.
And if you don't care about how much money you're paying in taxes, then maybe you shouldn't call. But if you care about how much you're paying, then you should take action today by calling and scheduling your consultation with one of our advisors.
Wonderful. Kevin, Pete, thank you so much. We encourage you to reach out to schedule your complimentary retirement checkpoint review today, 866-630-1675. Or again, you're welcome to scan that QR code and that will get you connected as well. Thank you so much for watching. Be blessed, and we'll see you next time here on Retire Well.